One morning in irony, an email was sent, just 12 lines long. There were no threats in the message, no confession, no dramatic language. At first glance, it looked like an ordinary internal warning, but that short email would later shape the foundation of an entire corporation. A company once described on Wall Street as unstoppable would collapse only months later. Billions of dollars in market value would disappear. Thousands of employees would lose their jobs, and investors would begin asking the same question again and again. Was this collapse the result of fraud? Or was it simply a single decision? A moment when someone saw the danger but no one acted. Today we are going to examine how a small internal warning, just a few lines in an email, became the beginning of the end for $1 billion empire. To understand the collapse, we first need to understand the rise. During the 1990s, the global economy was transforming rapidly. Technology companies were expanding at unprecedented speed. Energy markets were becoming deregulated. Investors were eager to fund anything that promised innovation. In this environment, a company called NovaEnergy Corporation emerged. NovaEnergy didn't present itself as a traditional energy company. It described itself as a revolutionary platform. Its executives claimed the company would transform the way electricity was traded around the world. Instead of simply producing power, NovaEnergy would build a digital marketplace for energy. Companies could buy and sell electricity contracts months or even years in advance. Executives called it an energy trading ecosystem. Wall Street loved the idea. Financial media praised the company as one of the smartest innovators in the industry. Magazine covers featured NovaEnergy's leadership team. Investment banks promoted the company as stock, and investors rushed to buy shares. Within a few years, NovaEnergy's stock price was growing by nearly 40% annually. Inside the boardroom, confidence was everywhere. The CEO was charismatic and visionary. The CFO was widely respected for his financial expertise. Employees believed they were building the future of energy markets. But beneath that success, something far more complicated was quietly developing, a system so complex that very few people fully understood it. NovaEnergy didn't simply sell electricity. The company specialized in financial contracts tied to future energy prices. These contracts allowed businesses to lock in energy prices for months or years ahead. In theory, this system helped companies manage risk, but it also allowed traders to speculate. NovaEnergy began predicting future energy demand and building contracts around those predictions. If the predictions were correct, the profits could be enormous. However, this system created a dangerous accounting structure. Many of the profits existed only on paper. Using a method known as mark-to-market accounting, NovaEnergy could estimate the future value of a contract and record that value immediately as revenue, even if the cash wouldn't arrive for years. This method wasn't necessarily illegal, but it relied heavily on assumptions. If those assumptions turned out to be wrong, the company's reported profits could collapse. Most investors didn't fully understand the complexity of the system, but they trusted the company's reputation. After all, major investment firms were buying the stock. Financial analysts were recommending it, and the company's growth numbers looked incredible. That trust became the first pillar supporting NovaEnergy's empire. But inside the company, some employees began noticing unusual patterns. One junior analyst wrote a note in an internal report: revenue growth doesn't match cash flow. In simple terms, the company was reporting large profits, but the actual money coming in seemed lower than expected. At first, this didn't cause major concern. Fast-growing companies sometimes show temporary differences between reported revenue and cash flow, but the pattern continued. During several internal meetings, questions about cash flow were raised. Executives responded confidently. The CFO explained that the differences were simply timing issues. He described them as temporary accounting effects. Most people accepted the explanation. After all, the company was still growing. The stock price continued climbing, and the media continued praising NovaEnergy as one of the most innovative companies in America. This created a powerful psychological effect. When success becomes consistent, people become less willing to question it. Doubt feels unnecessary, and warnings feel uncomfortable. Inside NovaEnergy, this cultural confidence slowly turned into something else, a quiet form of question suppression. Concerns were noted, but rarely escalated. One evening, a mid-level risk officer named Daniel Reed was reviewing several internal contracts. Daniel worked in the company's risk management department. His job was to identify potential threats to the company's financial stability. As he studied the contracts, something troubled him. Some projected profits appeared unusually optimistic. After examining several reports, Daniel realized the issue might be serious. Certain contracts were recognizing revenue based on speculative future outcomes. If energy prices change or if market demand drop, the company might face a liquidity problem. Daniel decided to send an email to his manager. The subject line was simple, urgent, revenue recognition concern. Inside the email, he wrote, based on current contract structure, projected revenue for Q4 may be overstated by approximately $180 million due to forward-booked speculative entries. In plain language, Daniel was saying something important. The company might be recording future profits as if they were already real. He added another sentence. If market conditions shift, the structure could expose the company to significant liquidity strain. The message was not dramatic. It was calm, professional, and analytical, but it was also a warning. And what happened next would change everything. Daniel's manager reviewed the email. Recognizing its potential importance, he forwarded it to the company's chief financial officer. The CFO replied quickly. Noted. Let us discuss internally. For Daniel, this seemed reassuring. It suggested the issue would be investigated, but no serious review followed. The company continued reporting aggressive revenue numbers. Investors remained enthusiastic. Media coverage stayed positive. And inside the executive team, there was little appetite for slowing the company's momentum. Admitting uncertainty could damage investor confidence, so the warning remained unresolved. The company simply continued operating as before. This decision, small at the time, would later become the most important mistake in the company's history. Several months later, the energy market began to shift. Prices started falling. Contracts that once looked profitable began losing value. Suddenly, NovaEnergy faced a difficult reality. Much of its reported revenue existed only on paper. The cash needed to support those numbers was limited. Credit rating agencies began asking questions. Financial analysts became cautious. Then a journalist published an article questioning NovaEnergy's accounting practices. The headline asked a dangerous question: is NovaEnergy overstating its earnings? The market reacted immediately. Investors began selling their shares. The stock price dropped. Confidence, once NovaEnergy's greatest asset, started disappearing. Inside the company, executives held emergency meetings. They tried to understand the scale of the problem. During one of those meetings, someone rediscovered Daniel Reed's email. Executives read it carefully, and suddenly the message felt different. What once looked like a routine internal concern now appeared to be a clear warning. One executive asked a simple question: why wasn't he escalated earlier? But by then it was too late. The company's share price had already fallen by nearly 45%. Banks began refusing new loans. Liquidity problems intensified. The situation was spiraling out of control. Within 3 months, the crisis reached its peak. The CFO resigned. Regulators launched an investigation. Investors filed class action lawsuits. And NovaEnergy filed for bankruptcy. A corporation once valued at $22 billion collapsed in a matter of weeks. Thousands of employees lost their jobs. Retirement funds invested in the company suffered enormous losses. An empire that once looked unstoppable had disappeared. Was this fraud? Or was it something else? Many experts describe the situation using a psychological concept called success bias. When organizations experience long periods of growth, they become less sensitive to warning signs. Positive results reinforce confidence. Leaders begin assuming that future success is inevitable. Inside NovaEnergy, this mindset had taken hold. Executives believed the market would recover. They believed the company's strategy would continue working. And they believed investor confidence had to be protected at all costs. But markets do not operate on belief. They operate on reality. Many people believe NovaEnergy collapsed when energy prices fell. But a closer analysis reveals something different. The true turning point happened months earlier. The moment Daniel Reed sent his email, that message represented the company's last opportunity to change course. If executives had responded immediately, they could have taken several steps. They could have restated earnings. They could have reduced the exposure to risky contracts. They could have communicated transparently with investors. Those actions might have slowed the company's growth, but they might also have prevented its collapse. Instead, the warning remained unresolved, and the opportunity disappeared. Investigations later revealed that NovaEnergy's accounting practices existed in a gray area. Some methods were technically legal, but they were also misleading. The CFO eventually paid significant financial penalties. The CEO received a lifetime ban from holding executive positions in public companies. Yet the people most affected were not the executives, they were the employees. Thousands lost their jobs. Retirement funds lost value. Communities that depended on the company suffered economic damage. Corporate collapse always has a human cost. NovaEnergy's story is not just about one company. It reveals 3 important lessons. First, growth does not guarantee stability. Second, complex systems often hide serious risks. And third, ignored warnings become more dangerous over time. Small decisions accumulate, a delayed discussion, a postponed investigation, a warning message that receives only a brief reply. Sometimes history changes because of a single choice. Even today, inside large corporations around the world, employees send similar emails. Risk reports are written, analysts raise questions, internal warnings circulate through the system. The real question is not whether warnings exist. The real question is whether anyone listens. Because NovaEnergy reminds us of something important. Empires rarely collapse in a single moment. They collapse slowly. When warning signs are ignored. When confidence replaces caution. And when a critical message receives only one response. Noted. And sometimes, the fall of $1 billion empire begins with nothing more than 12 lines in an email.